In this video, we're going to look at W.R. Grace & Co. This is a specialty chemical company. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I also look at their financial ratios and compare them to its competitors. And I do this with you on the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $3.3 billion. So it's a good sized company. And let's get their stock price, $49.19. So that's one share of stock. Now we need the free cash flow, and the way you value a company is you estimate the future free cash flows, then you discount that number back to today's value, and that's exactly what I'm doing in this video. And it looks pretty consistent, their free cash flows. Now I'm going to pull the net income, which is the profit and loss on the income statement, and we put 4 years of that into the model. The model does all the calculations. Now we need the revenue, which are the sales for each year. And it looks like their revenue has been increasing every year, which is good. The net income is all over the place. It was 94 million, dropped to 11 million, then ramped way back up to 168 and dropped to 126. But the numbers look pretty good, so we should get a good value. Now let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. They paid $76 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to the liabilities section. And then current debt of $23 million. That's debt due within 12 months. Long-term debt of $1.9 billion. That's debt due after 12 months. So they pay 3.9% interest on their debt. Interest payments are tax deductible, so let's get their income before tax of $183 million, their income tax of $57 million. This way we can calculate the effective tax rate. They pay 31% in taxes, which means the cost of debt is reduced to 2.7%. To get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. And the beta is 1.56, so the stock moves about 1.5 times the market. So it's not too volatile. Let's go back to the balance sheet, get their current assets. We need this to calculate the current ratio later. Current assets are mainly cash, accounts receivables, and inventory. That's $1.1 billion. And we also need their current liabilities to calculate the current ratio. That's $745 million. These are debts and payables that are due within 12 months. Their equity is $395 million. That's assets minus liabilities. And their EBIT, earnings before interest and taxes. That's $430 million. Let's look at a capital structure. They're 83% debt, and the cost of debt is 2.7%. They're 17% equity, and the cost of equity is 14.3%. So their WACC is 4.6%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. That's $4.3 billion. We discounted those numbers back to today's dollar amounts using the weighted average cost of capital, and we get a value of the company of $5.9 billion. We divide that by 67 million shares, and we get an intrinsic stock price at $89. It's trading at $49. So it's trading at a 44% discount, so it's a strong buy according to the model. Let's see what Simply Wall Street values the company at. They're at $75 a share, so they're also saying the company is undervalued. Let's look at the historical stock price. So the stock was trading in the hundreds a few years back, but then it's dropped, and it was sitting around $75, $80 for a while. Then it dropped again in March to looks like around $30, and then it's come back up to around $50. So stocks can always trade higher or lower than intrinsic value. Just because the stock is worth a certain amount of money doesn't mean people are willing to pay for it, because they may feel the future of the company is not going to be as strong as the past. Let's look at the financial ratios to get more information. Their PE is a little high at 26. That's price of stock $49 over earnings per share $1.88. To calculate earnings per share, that's net income over shares outstanding. So that indicates investors are willing to pay $26 for $1 of earnings. Usually you want to see below 15 for this ratio. They have a good price of sales of 1.7. That's price of stock over sales per share. And to get sales per share, it's revenue over shares outstanding. So investors are willing to pay $1.70 for $1 of sales. So that's a good ratio. Price to book of 8.3, that's price of stock, $49.19, over book value per share, $5.90. To get book value per share, it's equity over shares outstanding. So that means investors are willing to pay $8.30 for a $1 book value. So if the company filed bankruptcy, liquidated its assets, paid off all its debts, each shareholder would get $5.90, even though the shares are worth $49. So not a good return in that respect. Current ratio 1.5, which is great. That means current assets are 150% of current liabilities. Current assets 1.1 billion, current liabilities 745 million. ROE of 32%, which is really good. That's net income 126 million over equity 396 million. So they are providing a good value to their equity holders. Interest coverage ratio of 5.5. That's good. That's EBIT 430 million over interest expense 77 million. So they can easily cover their interest payments. And the best way to look at ratios is to compare them to similar companies. I did a video on LyondellBasell, and they're in the same industry as Grace. And LyondellBasell has a better ratio in every category than Grace. That's not to say that Grace is a worse company, but maybe LYB is just a really good company. So let me know what you think of the video. Leave a comment. Thanks for watching.